Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to the latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at DealCatalyst. Joining me today is Phil Titolo, Managing Director at Hunter Point Capital. Phil, good to see you. Thanks for joining me today. Appreciate your time. How are you?
Thanks, Todd. Good to see you too. No, thanks for having me.
So you've been with Hunter Point for about a year now. I think that's around the time that Hunter Point closed their debut fund. And it seems to also have coincided with the explosion of fund finance and the fund finance market. Can you talk a little bit about some of the motivating factors as to kind of what is behind some of this exponential growth, which seems to be kind of taking over the credit markets right now?
Yeah, happy to. So obviously you've had some great prior podcasts before we're recording this. Chris Freeze was a great podcast to listen to. Agree with a lot of what he says around the impetus for the explosion, but I want to take one step back. So I started my career really in fund finance in 2017. One thing Chris talks about was, before fund finance was hardly even a panelist on one panel at a big conference, and now there's a whole conference in Florida dedicated to fund finance. It shows you the evolution and the growth. But I started my career, I did one portfolio loan back in 2017, back when no one was talking about fund finance as an asset class, asset-backed finance, any of this. And actually wrote a business plan at MassMutual to build an effort around this. And what's interesting is I've seen this from 2017 till today, all the way through building the effort at MassMutual. We're running 26 billion at the end of 23. It's definitely been an evolution, but the key factors are really twofold. One, bank disintermediation has been a long-standing trade. We've seen it with direct lending first. We saw that come off banks' balance sheets for the most part. But banks aren't going away. Banks still serve a very useful component in the direct lending space, as well as in this fund finance space. But really what you're seeing is the innovation and the evolution of capital markets around private funds. So back 25 years ago, the equity markets in the US actually used to be, call it 65-35 public private ownership. Today, it's actually flipped. It's 65 private and 35 public. Because of that, there's been a lot of capital formation in the private markets for both the equity and the debt. And because of that, there's a lot more need for financing, whether that's at the fund level, at the underlying company level, smaller portfolios of collateral. And that's really where you've seen where insurance companies in particular come in with longer duration capital than banks typically have. Banks typically top out in the 3 to 5 year space. Insurance companies, especially life cos, want longer duration. It just matches up better. But they are not a bank. So it's hard for them to marry the two pieces. And that's really where the fund finance market and a wave of specialists that come into this market to be able to see what the need is of a capital need and bring that in a structured, rated context to insurance companies. And so that really, those kind of two functions, the innovation and the need of insurance companies for investment grade debt, married with some of the types of banking that was typically done on banks' balance sheets and now coming off of it, specifically around private funds. That's really where we've seen a lot of the demand and the evolution.
So from a more of a Hunter Point, perspective, just to learn a little bit more about kind of where you fit within the broader ecosystem. What is the product set, and is there kind of an ideal GP for that product set?
It's a great question. So Hunter Point Capital, I joined here a year ago. We've been founded 5 years ago by Bennett Goodman and Avi Kalkstein. Uh, what we do, we started out doing GP stakes, really for the middle market. We think there's a big inefficiency there. And that was the fund you were talking about that we closed our first flagship fund in stakes last March. We have now a financing side of the house. So when we talk to hundreds of GPs a year, we're hearing them ask about how can they solve capital needs. It can be everything from succession planning, M&A, financing a higher commitment to their funds, starting a new business. There's a lot of good growth, is what we kind of call it. Productive uses for that capital, whether it's at the management company or at the underlying fund level. That's what Hunter Point is the platform is situated to do. So we've got the equity, we have the financing that takes several different flavors, including a preferred equity solution, portfolio lending in various forms to either buy out growth or cash flowing assets, or a loan to the GP. So when we sit in front of GPs, we don't have to say we only have one flavor of a solution. We've got multiple ones, and really we're trying to help them get what's best for them and for our investors together. The best match is what I think makes it a win-win. So that's what Hunter Point from a platform's perspective does. We're independently owned. We're not part of a broader platform. And we are just dedicated to providing these types of capital solutions to GPs. This is different than maybe 5, 10 years ago when just having capital in the space really was the differentiator. Now it's a thoughtful approach and that you're not conflicted. You don't have a conflict of interest with maybe having a potential competing product outside of our lending space. We don't have that at Hunter Point with a firm that we're trying to buy a piece of, for example.
In terms of the products that you offer, I mean, are you seeing kind of, borrowers asking for, NAV facilities, succession? Like, is there one particular one that's kind of gotten, I guess a bit more traction this year? I mean, NAV facilities clearly have gotten probably the most publication and news for good
Yeah.
and bad reasons. Some of that
Yep.
might be overblown, but I mean, from your perspective, is there kind of, a flavor of these products that has been more popular the last, say, 6, 8, 10 months?
Yeah, I would say there's not really kind of like flavors. What I think is capital's problems or needs that GPs had either at the fund level or the management company level that typically were only solved historically by high cost equity dollars. Now there's a wider spectrum of solutions, right? And Hunter Point is built to offer all of them rather than just focus on one. Because when we meet with a GP, we and they sometimes don't, most of the time, don't know what they actually need. So that's the
Got it.
beauty of being able to kind of mirror those pieces.
One thing that we've been, at least when we're putting together our event, have been hearing a little bit more lately is, especially for earlier stage funds, the learning curve of, hey, maybe I've gotten a subline or a fairly simple product in the early stage of our fund life cycle, but then what does that graduation look like to the more sophisticated product ultimately becoming, say, a CFO issuer, and how big the learning curve is there from that initial subline, maybe simple product, all the way up, and what that learning curve looks like? I mean, are you seeing a learning curve with the GPs that you're working with? And maybe what are some of the key questions that you're asked when you're talking to GPs?
Yeah. Every conversation with a GP is kind of unique, and that's actually one of the things that excites me the most about what we do at Hunter Point is we are problem solvers, but we're doing it in a way that works for everybody, including our investors and the GP. So, for example, a younger manager that just started, they depending on their background, they're probably gonna need a subline, maybe warehousing. Those are bank-like products typically.
Yeah.
And that's not an area that like Hunter Point or another non-bank lender will kind of be able to help them with. But once they're able to raise their first fund, whether they need leverage or to offer a leveraged share class and an unleveraged share class, whether that manager needs help financing their larger GP commits, given the tough fundraising environment these days, they're being asked to add more to their GP commit. There's all these different ways that we can work with even a smaller, younger type manager. What's been most interesting in especially with kind of middle market space, a lot of investors, and I've been an allocator my whole career until I joined Hunter Point. What's interesting is a lot of these GPs, they're really good at what they do in their asset class or their business. But thinking about it from like a capital efficiency or optimization at the GP level, or thinking about the different ways to offer structure to insurance companies or different types of investors at their fund level, that's not really their ballywick. That's not really what they're spending their time doing. They just want to do good investments and run the business. So that's where us kind of coming in as a consultant and saying, what's your problem? What are you trying to work on? And how can we help? And then us having the tools to give them to solve, that's really been powerful. And it feels almost like a combination of uh, being a strategic advisor to them, but also having the capital to solve that need. Um, that's where we're seeing a lot of the middle market of GPs come to us for solutions.
The other big trend that we're clearly seeing is insurance participation. And creating products that are appealing to insurance companies. Obviously, there needs to be ratings associated with them.
Yeah.
um, but it is confusing at the same time, because insurers can be LPs, they can be investors, they can be lenders. I mean, as someone who used to be in the insurance space, can you maybe break down a little bit of how insurance companies play within the market, and maybe cut through some of that confusion? Because as a non-practitioner, it's kind of hard to follow who fits where and why they fit there, and how they fit there. And so curious to kind of hear a little bit more from someone that used to be in the insurance space.
Yeah, and I was kind of smiling to myself, Todd, because once you're fully ingrained in the insurance space, it doesn't matter what your business card says, you're still in the insurance space. There's no chance I can get all the insurance out of my head, which is a good thing. I honestly really do enjoy it. Um, but to your point, insurance has grown exponentially in various ways. And what you've seen with the legacy traditional insurers that have been around 150 years, and then you have some newer entrants or private equity backed entrants. There's a lot of now kind of gray space between asset managers and insurance companies because there's a lot of the same synergies. Because of that, you're seeing, to your point, you've seen a lot of insurers buy stakes in asset managers. You've seen asset managers now buy stakes in insurance companies. And what they're trying to really do is harness the power of what the liabilities issued under insurance, how those can be mapped and be really taken advantage, can take advantage of the investment prowess and options that the asset manager can offer. Everything is predicated on, really, in insurance world, the form. So getting it rated, investment grade debt piece rated, is critical for lower capital treatment. That also obviously helps drive the ROE and helps drive the product innovation on the insurance side. So a lot of insurers, I always laughed when I was at Mass Mutual in the Hartford beforehand. I laughed because we would have asset managers come in and say, your balance sheet at Mass Mutual was over 200 billion. Can I please have an LP check for $1 billion? And we would laugh because that is such a simplistic way to look at an insurance balance sheet that is 90% plus fixed income driven, right?
Yeah.
Because of the liabilities they're writing and so because of that, the equity dollars are very tight at most insurance companies, but the appetite for investment grade, higher spread, lower expected loss, investment grade debt, that's where I think the biggest value is. And that's where you see things like Chris talked about, the CFOs, taking what was a portfolio of fund interests that collectively have underlying debt underneath them or have lower risk characteristics, and issuing debt senior to the equity. That's definitely an area where I think, if done right, and to his point, we don't want to have, as an industry, we want to make sure we're doing it thoughtfully and in conjunction with regulators and the insurance space to make sure it's appropriate. But really, if you boil that down, what it comes down to is all about the efficient allocation of risk and return. Insurance companies have a borderline insatiable demand for investment grade rated spread product, and that's where you're seeing alternative asset managers look to create structures and translate that risk and return into consumable forms for insurers. And to me, I couldn't be luckier to be kind of in that flow and have done it for now almost 10 years, when Not even just now, it's becoming such a big, hot topic.
Are there particular questions that say insurance companies who have not yet participated in some of these structures, is there a common question or common theme that they're asking before maybe participating in some of these structures? And to the structure point, um, and kind of the risk here. Um, it- is there a risk at some of these structures being quote unquote manufactured or kind of done in a way that there might not necessarily be the perfect set of assets within that, and is the rating real? Like, is there any risk of that? It was clearly an issue way back in 2008 and got us into a lot of trouble. There's all this talk about leverage on leverage, but maybe talk to a little bit of the questions insurers ask, and then B, kind of what are maybe some of the risks involved here.
Yeah, definitely. So two things. One, the revised principal-based bond definition under the NEIC SVO came out and last year and was in effect Jan 1 this year. So a lot of insurers are definitely looking at that and trying to figure out what do they have on the books. There's no grandfathering of prior holdings. They're looking at what they have on the books and making sure everything meets that definition for what's called filing exempt status. That's where a rating agency rating can be used for capital relief. That's going to be a big theme this year. It already has been. I speak to a lot of my insurance brethren and sisters to talk about, hey, here's what you should keep in mind from my perspective, because I've been around this part of the discussion. What's really critical is it's amazing how much kind of hearsay and game of telephone goes on in the industry when the definition for a bond under the principal-based bond definition, if you take the two pieces of it, it's about 17 pages long. Because of that, I always tell people don't listen to various talk that's out there. Just go direct to the regulation. Read it yourself if you're interested. I think it was done thoughtfully, and I think as folks get to digest it, it's going to be clear what they have on their books, whether it meets it or not. Um, yeah, I think there is potential risk for some folks doing deals for insurers that they thought would meet the definition that maybe don't. The next 12 to 18 months, I think, is really going to flesh out maybe some of those areas and some of those structures that may or may not. But what I've seen be concerns for various market participants is, are you just translating equity risk into debt structure for capital purposes? I think that's a fair concern and a fair concern that people need to be looking at their investments and objectively trying to assess for underneath the new definition. In terms of what insurers are looking for, they're also taking the new regulation regime that's coming into play, but also there's been a lot more competition, especially in the annuity issuance space, for higher spread investment grade products. So that kind of tension is actually very frothy right now, where folks are worried about making sure they don't do something that may or may not be deemed a bond under the new regulations, but they're also looking for higher spread investment grade rated product to fund their liabilities. I think that's going to be the tension over the next 12 to 18 months we need to see play out.
In terms of the looking back towards fund finance products and kind of the
Yeah.
role securitization, which is some obviously what Chris and I focused a lot on.
Yeah.
CFOs are clearly becoming more prevalent. I think there was at least one public subline securitization. How do you see securitization technology playing a bigger role? I know Chris talks a lot about CFOs. Do you see securitization playing a bigger role in some of these other products? Like, what could the product set look like in 2 or 3 years from now? Is it that much different, that much more sophisticated?
I think something that Chris said in his podcast was spot on. I wouldn't have called it a super cycle, but I like the way he said it around issuing CFOs. The reality is under CFOs, you're using a proven technology, CLO, waterfall, and a senior subordinate technology to effectively and accurately, I think, allocate the risk and the potential return to different levels of the securitization. In that form, securitization is a very useful tool to divide clearly and delineate the risk and return. In some of these structures, it may not be as clear, and especially when you have multiple levels below the CFO. Some of those structures, I think, I think folks need to dig into more on the structure side. One thing that Nicole, your prior podcast interviewee, what I thought was great, structure matters. I'm a
Yeah.
bankruptcy lawyer specialist. I went to law school. To me, you as a lender, you always want to make sure the structure is done right up front because there is no better time to get it right than right at the close or before the close. Once you're off and running, once things have been funded, the structure, the security package, the perfection of the security interest, those are all baked. Very hard to put that genie back in the bottle. There are some deals that I think I've seen go off in the market that I think folks are going to wish they had focused on the structure maybe a little bit more before they closed. Again, I'm a credit guy, so I'm always trying to think of the downside, protecting on the downside than I am of worried about what the on the upside is. Um, Definitely, securitization has a role. I think it helps with uh, broadening the universe of buyers and bringing in new participants. You've seen that with CLOs, you've seen that with various forms of ABS. I think CFOs and other securitization methods in this space just makes too much sense. There always, though, will be a need, I think, for a relationship lender. A lot of lending is still a relationship business. So in relationships to a securitization, it's less direct, it's less clear as to who your ultimate lenders are.
Well, that kind of was going to lead into my next question and asking you is like, if I'm a GP, is my ultimate goal to get to become a CFO issuer, or does it really just depend on what the goals of my fund or multiple funds might be? Because like you just said, securitization, you don't necessarily have the same tie with your investors as you would otherwise.
I've had a few GPs come to me here at Hunter Point and say, "Look, I've heard you've done some securitizations and fund finance things. We would love to do one with you. How do we do it?" And I say, "Well, looking at what your asset class is, and it's a single strategy, let's just use, for example, a private equity single strategy
Yeah.
manager. If they want to do a CFO, I say it's probably not the right fit. And it's just being blunt and saying, look, there is a certain type of asset class or diversification that is needed because what's underpinning these securitizations is the ability to appropriately get the debt rated investment grade. There may be a way to get certain more concentrated strategies rated investment grade for a CFO or a securitization. I'm not sure that is the right approach at the type of advance rate levels that those CFOs typically do. But when you have debt underlying or diversified pools, I think it makes too much sense. And I do think a lot of managers are starting to realize there's another way to access insurance capital for their private alternative strategies, but also to augment kind of what I've seen also is sometimes there's crossover, meaning pension or sovereign wealth or high net worth may want a different tranche of a CFO than the insurance company. And there's actually a really nice marriage between different investor types at the same asset manager. I think that's going to be a trend we see continuing for a while.
So we have just a few minutes left. I try to end a little bit more lightly as we go out the door. So a
Yep.
few fun questions for you. Do you have a favorite sports team or teams, or if you don't, favorite hobby?
So my favorite team in the world is playing their opening day today, the Yankees.
And now I don't know if we can be friends because I'm a Mets fan. So
I'm sorry to hear that. Well, you got Soto, you can enjoy it.
yes, that's true.
And you got Clay Holmes too from us. So definitely the Yankees. I went to Boston College. I'm a big alumni supporter. So Boston College Eagles, very big. Hobby, I've got a few interesting ones. The one that I'm most involved in day to day now is I coach my sons. I have twin boys, travel soccer team. Love coaching and I obviously get to coach, but be part of the game, but then also get to spend time with my kids.
Yep, I can understand that. I have two boys myself. Tell us one surprising thing about yourself.
One surprising thing. Uh, I have always wanted to be a EMT. I have
Hmm.
actually in my office, I have all the books to study and hopefully shortly go for my practicum to get my EMT license. I have a defibrillator in my car at all times and one in the house, and always thought that was a skill set that, is very good to have.
What was Is there any particular reason? Is there a family member that was an EMT or?
Nope. I'm just very, very curious person intellectually, and I'm actually pretty good. I'm pretty good with
Interesting.
blood and gore, so that doesn't spook me.
Most exciting part of your job?
Twofold. One, I absolutely love educating and just bringing people that I work with into my world and sharing the knowledge that I've been fortunate to gain. I was incredibly fortunate to come up under Robin Diamani, who's the CIO still at RTX. I worked for her a long time ago at what was then United Technologies. Joe Fazzino, who's the deputy CIO there as well, and then Charles Van Vliet, who's the retiring CIO of Textron Pension. They brought me under their wing and taught me everything I know, and I'm incredibly thankful for that. And I think it's my duty to pass that on. So I really do enjoy that. I think in another life, I probably would have been a teacher. Um, Another exciting part of my job is I love it when a GP comes in and says, I've talked to 3, 5 people. No one can solve this problem. Can you please help me? And then we can try our best and then we actually do solve it. I love that, blank space whiteboarding approach.
Well, I could certainly attest to your, your knowledge and ability to give your time, which has always been very thoughtful. So thank you
Thanks, Todd.
for that. And then final question is one prediction for the next 12 months.
Let's see, one prediction. I'm really hoping that in the next 12 months, the Yankees finish what they started last year and bring home the World Series. That's my prediction. I'm typically wrong in sports predictions, so I guess that's my prediction is that'll be wrong.
I guess we'll see. And hopefully, for my purposes, that doesn't happen, but it happens with the other team in town. So,
We're
Phil,
14 years away from the last Subway Series. Let's make it again.
yep. Well, Phil, thank you very much for your time. Always incredibly gracious. Appreciate it. And, continued success at Hunter Point.
Todd, thanks for having me. This was great. We'll talk soon.
Yep. Thank you. Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout.